But thank you all. This is the last in our series of just in-person conversations. And I want to introduce David Seidelman. We have a bigger umbrella, which we sort of cross into what I'll call well-being across the board. And I think well-being clearly spans your ability to access food and mental health support services, your ability to have exercise facilities on site, other resources available to you. And we've really felt strongly about financial support structures and resources that help you when or should something arise or should there be challenges, that you have a place to turn and a person to turn to for questions and answers. And we've partnered with David Seidelman for several years now, and we have a resource packet for you that lists well-being resources. We have several financial advisors in that packet that you can reach out to, and we encourage you to. None of them, including David here, charge to meet with you because the whole point is to help get you the necessary resources to help take that piece of stress off of your shoulders. Because the last thing you need while you're learning all these apps and medicine and pandemics and all this jazz is to feel stressed by your finances. And so I am happy that David's able to take the time. Historically, he has created office hours, or now in the virtual world, more of a space where you can meet with him one-on-one and or as a couple, or any decision you'd want that would share in your financial decision making to kind of think through some of the challenges. And I think he's helped a lot of residents really gain some clarity around their own finances, around, some common resident questions. Should I rent or buy? And all of them are complicated based on finances, situations, et cetera. But I think he can provide you some common sense guidance, which is always helpful. So put this in the category of building references. I don't expect you to remember all or even part of what we're discussing in the next 2 weeks, but I do want you to know the resource exists and someone knows how to connect you to it. And that's the big takeaway. So David, thanks for taking the time. Welcome to the 99 new interns and residents starting at Hennepin amidst a really challenging time. So thank you.
Absolutely. Yeah, well, first off, congratulations on your residency at Hennepin. Dr. Walsh and the staff around you, they care about you. They care about your training, your experience, and your success. And you're working with a great team of people. And thanks for your attendance today. Before I begin, I'd like to point out that I am a certified financial planner, not a certified public speaker. And add in the uncertainty of technology, we'll see how this all goes today. So I am here to discuss some of the main financial topics that are relevant to you now as you're beginning residency. Well, let's see. All right, here we go. So now you've been studying medicine and not finance. So many of you may have questions about your money and making smart financial decisions. And the financial decisions you're making today, or actually choosing not to make today, will have a big impact on your future self. And you'll want to make great financial decisions that your future self will thank you for. And that's really what planning is all about, is planning, like planning a vacation or buying a car or planning your finances. It's making decisions your future self will thank you for. And as Dr. Walsh pointed out, I am available as a free financial resource to answer any questions you have to help make those important financial decisions. And I can help not only while you're at Hennepin, but throughout your entire career, long after you've graduated from residency. Now, many of you may not know much about finances or even know what financial topics to discuss or questions to ask a financial planner, and you're not alone there. I meet with people at all different degrees of financial knowledge, and typically I do hold face-to-face meetings, but I have been meeting remotely as of late, and hopefully that'll change in the upcoming months. But for now, the Skype format has been working and it's been successful. I've got clients across the country, and so these remote meetings, I'm no stranger to those. So it's kind of the new normal now. So one of the tasks that you were asked to complete was the monkey survey. And thanks to all of you for completing that. I did get 98 responses. So if it's a class of 98, all of you participated. So I appreciate the numbers. That's fantastic. So when it comes to finances, building savings and understanding cash flow and saving for retirement were of the highest priority. I was kind of surprised that 40% of you wanted to pay down your student loans aggressively. And perhaps after our session today, that number will go down. I have a counterintuitive strategy that we can kind of talk through that might make sense. However, it might actually raise more questions as we're talking about it as well. But a third of you weren't 100% sure where to focus financially, and hopefully the topics we discussed today will help you zero in on those things to be thinking about over the next few months. And hopefully by the end of the session, you'll be better prepared to make those great financial decisions that your future self will thank you for. So we're going to touch on cash flow and building savings, home purchasing, Hennepin benefits, disability insurance, and student loan repayment. That's a packed agenda, and it's I'll have to talk fast, I think, but hopefully have enough time at the end for questions. Well, mixed in here for questions. So regarding cash flow, it is important to understand your cash flow. It's not always fun, but it is important. Without understanding your cash flow, it can be a challenge to feel free to do the things that you want to do. So having a solid idea about where your money going might take some time. It might take a few months to refine. And as of right now or soon, you'll be receiving your first paycheck. Yay, right? And you may have been putting off buying things. I call this the spending honeymoon phase. So you may be buying a lot of things over the next couple months, and that might even happen again once you start earning that larger income as you're transitioning to practice. But as your spending does regulate over the next few months, it's a good idea to track where cash is going. And there are a lot of online applications you can download to help understand your cash flow. I do have a cash flow worksheet that I can email if you're interested. Just shoot me an email and I can get that to you as well. You'll also, it's important to build that savings or emergency fund. Emergency fund is a pool of money that you don't plan to dip into unless it's emergency. So it's separate from your checking and savings account. And a good real rule of thumb is to save 3 months of expenses to build that and build that savings to that level. If you can even get to 6, that's even better. But for now, focus on 3. And to find that number, again, that cash flow worksheet or understanding your cash flow is important. Now, 28% of you did indicate that you're hoping to purchase a home. And now the guideline for a home purchase is 10 to 15% of your gross income. So if you're making $55,000, your monthly mortgage would be between $450 and $700 a month. And so I take $55,000 and multiply that by 0.15 and divide by 12. So 55,000 times 0.15 divided by 12. Now, on your resident salary, you might go outside of that range in anticipation of future income. So you can use your future earnings as your beginning number in that case. But understanding what your cash flow is during residency will help figure out the mortgage that you can afford. Another home purchasing rule of thumb is making a down payment of 20%. You've probably heard that number. Now, the reason why 20% is this magic number is to avoid private mortgage insurance, or PMI. PMI is insurance that you have to buy in case you default on your mortgage, and it can cost like $150 to $250 a month. However, if you go through a lender that has a physician mortgage, you could bypass the 20% altogether, or maybe a 5% down payment, 0 to 5%, and also avoid PMI. So when you are ready to look into financing and things, I can provide a list of lenders that do provide that physician mortgage. Next part here, I'm going to be working through some of the stuff that is available through your benefits. And it can be found in the document here that's on the screen. But I'm just going to be touching on some main topics here. And I do know that there's a pre-recorded session that goes through some of this as well, so I won't spend a lot of time here. But so at Hennepin, you have two main ways to save for the future: your 403B plan and a 457 deferred compensation plan. Now, because Hennepin puts money into the 457, that's really where I think you should focus first. If you put in 3.75%, they will match that up to $2,000 a year. So $4,000 a year going into that. So with this slide, the two main takeaways is the 457, there is contribution by your employer there, where the 403B, there in the green circles, there's no contribution. And then the red circles there is with the 403B. If you put money into your 403B, it's really geared for retirement, where if you do pull out money before age 59 and a half, there's a 10% penalty on top of the taxes that you'll have to pay. So with the 457, on the other hand, though, you have full access to all of that money once you terminate employment at Hennepin. So when you're no longer working at Hennepin, you can pull that money out with no penalty. Taxes are due, but there's no penalty on any distributions there. So here is a planning idea for that 457. And most of you, I think, will be contributing to it. It's an opt-in option. But if you're putting $2,000 in and Hennepin's putting $2,000 in, so $4,000 a year, over 3 years, you'll have $12,000, or if you're a 4-year residency, it'll be $16,000. So that's a pretty nice chunk of change there. So after you leave Hennepin, those dollars are available without penalty. You can have the taxes paid out of that balance. So on that $16,000, maybe you'll have $12,000 of cash available to you. Now you could take that cash and pay down your student loans, or you could use it for a down payment on a house, or use it to fund a Roth IRA, or you can leave it where it's at and use it at some point else in the future to maybe for your kids' college or for your own retirement. So it is a deferred compensation plan. So you're deferring your income till some future date. So it's a really nice benefit that Hennepin has. So $2,000 of free money there.
David, can I make just a little comment, which I think is stating what you've already said, but just repeating it?
Yeah.
For Hennepin residents, so those of you who are transitional residents and you're employed by the University of Minnesota, they have a different plan for you as far as retirement plans go. So you really need to be watching carefully when you have your benefits talk at the U. For the Hennepin employees, however, you will be given paperwork that has you make a decision. You're either going to opt in for your Social Security deduction into Social Security, or you can choose to have your Social Security instead moved to a deferred comp plan. And this is a benefit that is available to Hennepin County employees, and it's sort of a grandfathered benefit, I guess, because we were a county entity back in the day. So you will have to actively check the box that says, I'd like to defer all my Social Security to this 457 plan. And we'll help take you through that when you fill out your benefits for HR, but I just want you to know it's an action step you have to take.
All right, thank you. We just rattled off a bunch of terms that you may not be familiar with, like rolling over or tax brackets and 403Bs. When the time is right for you, I do encourage you to speak with a certified financial planner that does understand how the Hennepin 457 works. And if that person is me, I'd be happy to talk with you to make sure that your decision you're making is the best for you. A good time to stop maybe here for any questions, if there are any. Anna, I know Anna's going to be kind of watching the box there for the chat.
There is one question about if any of these plans are available to non-U.S. citizens.
I believe the 403B is, but I'm not sure.
I believe it is as well.
Any other questions?
And there's one more about at termination, your 457 can roll into another account, which someone asked. And for instance, when I was done with my residency, I rolled it into a Roth IRA, which was a different account.
Yep, had to pay taxes on that, but now you could roll it into a 403B, like your new employer's retirement plan. Now, if you do that, you are now locking that money away to age 59 and a half, whereas if you didn't roll it into that type of retirement plan, you have full access to it. So it's really what you plan to use the money for in the future. So, all right. Any other questions? Okay, so at Hennepin, you have two options for life insurance. There's term insurance and whole life insurance. Now, term life insurance is like renting an apartment where you pay your rent, you can live in your apartment. If you stop paying your rent, you have to move out. Term insurance is like that. You pay for a certain period of time or a term, and when that term is done, it's gone. Now, whole life insurance is like a mortgage where you pay your mortgage for 15 or 30 years, and you can stay in your house once your mortgage is paid off. Whole life insurance is like that. You pay for a certain period of time, and eventually you can stop paying, and you can keep the insurance. Now, it's called whole life because it stays for your whole life. Typically, though, whole life insurance is a lot more expensive than term life insurance. So it's worth understanding the differences, but most residents do tend to stick with the term insurance. Now, Hennepin does provide $50,000 of basic term life insurance and also $50,000 of accidental death and dismemberment. So if you pass away due in an accident, you'll receive $100,000. So $50,000 from the term and $50,000 from the accidental death and dismemberment. If you happen to pass away from natural causes, you would get $50,000 from the life insurance, but not the accidental death and dismemberment. Does not apply there. Now, if you were to lose your hearing, sight, or speech, that accidental death and dismemberment would pay $50,000. And so you don't necessarily have to pass to get that benefit. Now, if you do want more life insurance than what's provided, you have the ability to get 4 times or up to 4 times your salary through Hennepin. And in my job, I do help people get and set up life insurance. And I shopped around quickly for a price comparison. And from what I saw, the Hennepin rates cost like twice as much as that which you can get on the open market. So if you're thinking about increasing or getting more than $50,000, you should talk to someone that can, find out what that right amount is for you and help you through that application process. And that's something that, again, I can help with and likely find a price that's half the price of the Hennepin coverage. So Hennepin also does provide and pay for short-term and long-term disability insurance. Well, first, what is disability insurance? Well, disability insurance is not health insurance. Health insurance pays for medical bills, where disability insurance protects your income. So what if something does happen that derails your ability to earn a paycheck? If you're too sick or hurt to work, what would happen to your financial world if your next paycheck was your last paycheck? If something happens to you that causes you to miss work, especially early on in your career, there could be significant financial repercussions. So that's where the disability insurance kicks in. If you're too sick or hurt to work, the insurance company will send a paycheck. So Hennepin does have short-term disability. It'll pay 100% of your salary for 3 weeks, and then after 3 weeks, it'll pay 60% for the next 10 weeks. So the short-term disability insurance pays for 90 days, and then your long-term disability would kick in. And that does pay at 60%, and you are automatically enrolled in both of those, and both are employer paid. So the next Survey Monkey question that we'll go through here is regarding purchasing disability insurance. If I have long-term disability insurance through work, do I need to get my own? Now, 16% of you either already have disability insurance or are in the process of getting it. So that's great. Now 49% of you said that you need more information to make that decision. And hopefully what we go through next will help with that. So in my job, I do also help people get disability insurance, and I look a lot at employer-provided benefits. Often, the information you receive from employers is like a little 1 paragraph long, and that is what you do get from Hennepin in that benefit overview booklet. So I did take a look at something called a plan document. It's Hennepin Long-Term Disability Insurance Plan Document. It's 35 pages long. And I've summarized here how that's going to work here for you. So first, let's get an example here of your base without being disabled. So with your salary of $56,353, if you are not disabled, obviously we have to pay taxes on that. So your monthly income will be $3,287. So that first paycheck is going to feel pretty nice. Now, let's say that you're working for 6 months and something happens that causes you to become disabled. So what are some of the examples of something that might happen that might cause you to be too sick or hurt to work for 3 months? You may slip or fall on the ice and hurt your back. What if you hit your head and become concussed? Maybe after 3 months, you're still able to work, but not full time. What if you fall off a ladder or diagnosed with MS? Or maybe harder would be, if a loved one dies and that really takes a toll on you and you slip into a major depression and you're not able to function at work normally. Often I hear, I'm healthy, I won't become disabled. And depression is a really good example of one of those things that can happen that you really have no control of. Well, you can maybe control it, but it might take some time to get the medications just right. So let's move to an example here of if you do have a disability, your employer-provided disability insurance would kick in after being disabled for 90 days and it would pay 60% of your income. So now, because your employer is paying for the disability insurance, you would then have to pay taxes on that benefit. So after tax, your monthly income would be $1,972. So that's $1,300 less per month than you were normally making. So imagine your income cut by 40%. Now, what kind of things would you have to cut out? Maybe you'd have to downsize your house, or maybe you wouldn't be able to save for your kids' college, or maybe you couldn't save for your own retirement anymore. Whatever it is, there are probably some pretty major cutbacks. Now, for most residents, living on $2,000 a month won't cut it. And if you're disabled for your entire career, you'd get that $2,000 a month through age 65. Then what happens in retirement? That $2,000 a month goes away, and many of you haven't worked enough to receive Social Security. Social Security is based on a formula of the income that you've earned to date. So that Social Security check might be kind of small if that is the case. But let's assume that a 40% reduction will be manageable, and $2,000 a month works. So maybe you don't have student loans or a mortgage, or maybe you plan to live with mom and dad for the duration there. But oftentimes, it's the definition of disability in an employer-provided disability insurance that isn't very strong. And that's kind of something to key in on here. For Hennepin residents, there is a 1-year regular occupation, then it switches to an any gainful occupation definition. So what does this mean? So an any occupation definition means if you are disabled and can work in any capacity, like flipping burgers or say, hello, welcome to Walmart, they will not pay your benefit because you're able to work. Now, regular definition says that if you are unable to perform your job as it is normally performed in the national economy, they will pay your benefit even if you're working in some other capacity. So if you're disabled and you'll receive your long-term disability benefit, that $2,000 for the first year, but after 1 year, if you can do any other work, that $2,000 a month goes away. So that's pretty impactful there. So oftentimes people do stick with their employer-provided disability insurance. And if I had to guess, over 90% of the documents, those plan documents I look at, have a 2-year own occupation definition and switch to an any occupation definition. So not a very strong contract. Also, to save money, employers also have policies that have limitations on them as well. So not very robust. And most residents do understand that they're vulnerable and need to protect their income, not only their income as a resident, but protecting their future ability to earn an income. A few years ago, I met with a first-year emergency medicine resident, and he said he bikes recreationally and commutes to work occasionally. And he recognized that he's at risk if he's hit by an inattentive driver. And though he says, though he wears a helmet, being in the ER, he can see firsthand what can happen. Also met with a general surgery resident. and she's graduating this month, and she's worried that if something happens to her hands, it could be financially devastating. And so these are just two examples of residents who felt it important to get personal disability insurance in addition to their employer-provided disability insurance. So now, if you are interested in personal disability insurance, there are two options: a medically underwritten policy and a guaranteed issue policy. With either of these, the key ingredient is that true own occupation definition. And there are the big six companies that have contracts with a true own occupation definition. And like I said before, I can help people find the right disability insurance and shop around at all of those different companies to find the one that makes sense. Other companies that aren't listed there, they do have disability insurance too, but they may have a weaker, or they do have a weaker definition. Like they could have a modified own occupation or an any occupation definition. So typically though, actually all the residents that I work with go with one of the big six companies there. All right. So medically underwritten, for some of you, this might be a best option of two. Really, disability insurance is the hardest type of insurance to get. It's hard to be approved, and that's because the insurance company scrutinizes the medical history of applicants. So of the people that apply, 15% of applicants are declined due to pre-existing medical conditions, and another 20% are approved, but with limitations that reduce or eliminate benefits. So maybe they have to pay 25 or 50 or 100% more premium, or maybe instead of pay towards all the way till retirement age, it pays for 5 years or 10 years. So what are some of the medical conditions that could cause someone to be declined or have a reduced amount of benefits? That could be like asthma, sinus issues, a person's build, anxiety, depression, irritable bowel syndrome. So on the screen, there's some other ones that are listed there of the more common ones that might come into play. And usually when we're sitting in the group of people, like we could have been this year, I usually hear a gasp right around now about seeing those different lists there. But I did just meet with a pharmacist who has colitis. He was approved, which is great, but his premiums are 50% higher because he has the colitis. Last year, a resident applied for a medically underwritten policy, and she was declined. She's 27 years old, and she was declined due to unexplained fatigue since August of the prior year. And she had also recently experienced unexplained back pain and piriformis syndrome. So because of those recent medical history items, she was declined. Another resident I met with had been diagnosed with work shift disorder. He's currently in underwriting, so we'll see how this turns out. But he had told me that he wished he had gotten his disability insurance right away at the start of residency, or else this might not have been an issue. So right now you might be feeling good and that nothing's going to happen to me, and hopefully that's the case. But trying to manage a work-life balance with the stresses of work and demanding hours might have unknown long-term effects on your physical and mental health. So if you do have a medical history, even something that you think might be medically insignificant, underwriters look at disability insurance through a different lens. So based on historical claims data, might this condition present itself sometime in the future to keep a person out of work for an extended period of time? So that's how they're looking at your medical history, is might it present itself in the future? Now, fortunately for the residents that I mentioned, and for you as Hennepin residents, you do have another option. It's a guaranteed issue policy. So we'll take a look at that here. All right, sorry here, just getting things in order. Okay, with the guaranteed issue policy, there's no medical underwriting, there's no medical questions, there's no labs, and there's no exam. So this guaranteed coverage is only available to you as residents. So once you're done with training, you are no longer able to get this personal disability insurance on a guaranteed basis. So this is a pretty big deal. So if for some reason you don't want to get disability insurance in your first year as a resident, you'll want to be sure to find me sometime before you graduate to talk through that guaranteed option. So now it is, Megan mentioned that some of you are paid by the University of Minnesota. So everything we're talking about here also applies to you. So that's important to know too. Now, once you do have the insurance, the disability insurance, you can keep it for your entire career. It's portable. So it follows you whatever job or career you're in. So if you're disabled in the future, it looks at the activities that you were doing before you were disabled to determine payment and that. So if you switch careers and are disabled as a carpenter, it would still pay your benefit even if you got it as a resident. The next bullet here, own occupation definition, that's a big deal. And what makes it even a stronger language is if you can find a contract with enhanced specialty language. And what that means is that if 50% or more of your income is derived from surgery or hands-on patient care, if you can't perform surgery or hands-on patient care, they will pay you 100% of your benefit, even if you're working in a different occupation. So let's say an example of a surgeon. She works 70% of the time on office visits and 30% in surgery. And let's say that 70% of her income, though, comes from surgical procedures. If she can't do surgery but can still do clinical work, she would get 100% of her benefit with that enhanced specialty language. If she didn't have the specialty language, the policy might only pay 30% because she's not working 30% of her job. So that enhanced specialty language can make a pretty substantial difference in if a policy a claim is paid in full or not. So if that enhanced specialty language does make sense to you and you're looking for it, that guaranteed issue policy we're talking about does have that. And it's also important to know that guaranteed policy is not subpar insurance. It's high quality, it's strong contract language, and it doesn't cost more than comparable insurance. So as you can see, it's a very unique opportunity for you as a HCMC and U of M resident with this guaranteed issue option. Only 3 programs in the country have this program, so very unique. So unlike group disability insurance, your employer is paying the premium, so you have to pay taxes. If you're paying for your disability insurance, there's no taxes due. If you also get personal disability insurance policy, you can get one with cost of living adjustments, so they increase as cost of living increases. You can get student loan protection where the insurance company pays for your student loans. Obviously, these benefits cost more, but they might be something to consider. And as a resident at U of M and Hennepin, you do get a 10 to 30% discount, and that discount does stick with you once you move along with your career. So it doesn't go away once you graduate. So now there is a caveat to the guaranteed disability insurance, and this was just a restriction that just took place January 1st. So the guaranteed issue policy is only available through Guardian, that's an insurance company. It's one of the big 6 that we talked about, so that's a good thing. However, if you've applied for disability insurance with any other insurance company before applying for the guaranteed policy, and you are either declined or approved on a modified basis due to something in your medical history, if you try and apply for the guaranteed issue after that point, Guardian will not accept your application. So when you're ready to apply for disability insurance, I recommend that you first apply with Guardian. Now, this doesn't mean you have to go forward with Guardian. You can go with whatever insurance company you want after that. But if you're not approved for some reason, you can still fall back on that guaranteed issue insurance. And I know all of this might be a lot of information, definitely, maybe confusing, and some questions as well. But I can help navigate through that whole process and find out for you what makes sense. So some of you may be wondering how much disability insurance costs, and it really comes down to the quality of the contract and how it's designed. So depending on the contract language and the design, it could be as little as $25 a month. Or if you go with all the bells and whistles, it's like $300 a month. So depending on the coverage you want, dictates the price. So some residents go with something really basic now for like $25 a month. You know, it's probably not ideal coverage for the long-term career, but some coverage is better than none. And then right before graduation, when they know that their income is going to be going up, they revisit things and improve their coverage with a more robust policy. So you've invested a lot of money in your education to be where you are today. So I can't stress enough how important it is to protect your income with disability insurance. Before questions here, a couple other benefits just to run through. You've got flex spending accounts at Hennepin. These are accounts that you can save money in on a tax-free basis, and you're reimbursed for either medical care or daycare expenses, or medical expenses rather, and daycare expenses. So you don't have to pay tax money on those expenses. But you'll want to be careful on how much you put into these accounts, because if you don't use the money in there, you lose it by the end of the year. So if you don't use it, you lose it. Another nice benefit is the group legal insurance. If you're looking for a will, power of attorney, or healthcare directive, it's a really inexpensive way to get it. You sign up here at open enrollment when you're selecting your benefits now. You can take care of your will, power of attorney, and healthcare directive, and then at next open enrollment, you can drop that coverage. It's like less than $20 a month, I think. So it's a good way to get those estate documents taken care of. All right. Before moving on to student loans, let's open up for more questions here.
So I think there were a couple that you may have touched on. One was, do you recommend seeking additional or separate disability insurance?
Yes, I do.
And then the other one was, how long does long-term disability through HCMC last, which I also think you had.
Yeah, pays through, it says normal retirement age, so that's right now I think 65.
Also, when do, the 457 retirement account, I believe you enroll in that in today/tomorrow.
Yep, you'll take care of that here shortly. Any other questions? Nope. Okay. All right. Well, let's see. We've got some more information to go through with student loans. But first, before moving on to student loans, you'll be receiving an email from Anna with a PDF attached to it. This is a response sheet. So if you could please complete it and email it back to me, that would be greatly appreciated. Due to compliance through work, I need to report back who was in attendance, and this document will help that. It will also be a place that you can enter comments and suggestions about my presentation, as well as your interest in future contact from me, and an option to opt in and out of a newsletter that I email monthly. The last thing I want to do is contact you if you don't want to be contacted. So if you're not interested, please let me know. I'd still like to get the form back from you because, again, it does help me with my compliance aspects of my work. If you are interested in meeting, there is a link in that on that form that'll send you to my online scheduling tool. Now, it wasn't behaving very nicely with Android phones, but it should be working with iPhones or the PC. So now, to sweeten the pot a little bit, for those of you that do return this form, I'm going to be drawing for 2 $50 gift cards. So that should come in handy. My email address is on the form, and it will be on the email that Anna will be sending. But if you'd prefer to send it directly to Anna, that's fine, and she can forward it to me. I do ask, though, that you return the form by June 19th. So that would be helpful. All right.
Sorry, I think we have one more question.
Yeah, great.
So someone is asking, in general, for disability in life, if they can enroll and drop at a later date.
So you're not sure if that's a question about Hennepin's benefits. You're automatically enrolled at Hennepin, so no need to sign up or drop that. If you elect for extra coverage through Hennepin for the life insurance, I believe you have to sign that up for an entire year and then drop it at the next open enrollment. If you do get life insurance or disability insurance on a personal basis, then yeah, you can get that at any time and drop it at any time. You can also reduce or eliminate benefits anytime you want as well. So that's modifiable throughout the life of the policy.
And for the 457 retirement plan, do you know the rules around enrolling and dropping that?
Yeah, so with the 457, once you sign up, you're signed up. They're going to always take 3.75% out. It's my understanding that is, once it's set, you can't change it through your entire time at Hennepin. With the 403B, you can change contribution amounts pretty much at any time, so up to 0 to 19,500.
And then who do we contact for additional supplemental disability and life insurance?
You can contact me, or I think Dr. Walsh also mentioned you'll be receiving a brochure that has, I think, 2 or 3 other financial people on there. So any of us should be able to help you. Would
you suggest putting more money away for retirement in addition to the 457?
That depends, right? Depends on other factors in your finances. If you have some debt, but if you do have cash flow that you are able to contribute, yeah, I do think it would make sense. In addition to the 457, the first place generally I recommend for residents is a Roth IRA. So not the 403B, because they're not matching. You might as well start your own personal Roth IRA. And that's something that I can talk through how to, what that is and how to set that up. I can help with that. Is that it?
That's it. I think it is.
All right. So let's see. Let's jump into student loans here. So we're going to go through loan repayment strategies and touch on 2 loan forgiveness programs. One that's a public service loan forgiveness and one that ends after 20 or 25 years of payments. Now, 18% of you responded that you don't have loans. So that's fantastic. Unfortunately, for the other 82%, not that lucky. So 25% of you have loans less than $200,000. And 36% of you have loans between $200,000 and $350,000. So these are big numbers that we're talking about. And this can be overwhelming and stressful, can be very emotional. And many of you might have questions that, I may not be able to answer all the questions, but hopefully point you in the right direction today. And if you're like others that have decided to sit down with me for a loan review, like them, you may feel additional relief from having a solid plan and some action steps. So based on the poll here, 41% of you had said that you want to pay your loans off aggressively, and about a third of you are planning on the public service loan forgiveness. And 3% are thinking of that extended loan forgiveness plan. Now, the good news is here that most of you are feeling pretty confident about your student loan repayment strategy, and 18% actually said that you're feeling very confident. So that's great. So what we're going to go through, even the 18% out there that don't have student loans, this may not directly impact you, but the information that you may hear will help through your career. If others that you're talking to do have loans and they're stressed out about it, you may be able to help them with some information. So the majority of you would pick the revised pay-as-you-earn repayment type. And as a blanket statement, that's a solid option. There are other situations, though, like if you're married, that it might make sense to consider being on one of the income-driven repayment plans, like pay-as-you-earn or income-based repayment. But before I get into those programs, I'd like to go through some high-level information. So as you know, the CARES Act was passed, and right now there's 0% interest on loans, which is fantastic. And if you were to be happening to be paying your loans right now, it's a $0 payment. Now this goes through September 30th unless they extend it. And so for most of you, your grace period is now and will stop 6 months from now. Or 6 months after your graduation. So unfortunately, you may end up having to start making payments in December or January rather than taking advantage of that $0 payment. Now you'll want to have your payment method figured out 45 to 60 days prior to your grace period ending. So that's around mid-September. Some people do submit their application for their repayment type sooner than that. And all it does is it just sits there at the loan servicer. They don't process it. So you might as well wait till that mid-September timeframe. So when you went through exit counseling, you had to indicate which repayment type that you'd likely go on. So this was actually not signing up for a repayment type. This was just an indication. So you actually do need to apply. If you don't apply, they will put you on the 10-year standard repayment plan. So again, that application should be submitted around mid-September. All right. So for those of you that have private loans, and some of you that have federal loans, you may want to consider refinancing at a lower interest rate. But it's important to know that the private loans have a fixed payment amount and a duration. They're not flexible like the federal loans. And if you were to pass away, the loans are not discharged like the federal loans are. They'll go away. The federal loans go away, but the private loans pass along to your family or significant other. To do some research, you can look at credible.com to compare interest rates. And I have heard of services that do help people find appropriate terms and interest rates. And GradFin is one of those that I've heard of that some people have used. But before refinancing your federal loans, you might want to stay the course for a year or two before making the switch. So if you don't plan on refinancing your loans and sticking with the federal loans, there are the standard and extended repayment over 10 and 25 years, or you may want to pay off your loans aggressively, or go for that forgiveness after 10 or 25 or 20 or 25 years, or pursue the public service loan forgiveness. Now, some people might think of deferring during residency, and that's not often something that I recommend, because an income-driven repayment strategy can actually help in that situation sometimes. Because there are some benefits to an income-driven repayment strategy, specifically revised pay-as-you-earn, that might help you in deferment, as well as a strategy if you're planning on aggressively paying off your loans. And I'll explain myself about that here in a second. So in terms of making picking a repayment type, there's different repayment types here. Based on time, I'm going to kind of skip around a little bit here, but for most of you, the pay-as-you-earn and the revised pay-as-you-earn is going to make a lot of sense. The formula for deriving payment is identical between the two. Income-based repayment is typically 30% more than the other two. But you'll really probably want to focus in on the revised pay-as-you-earn, like most of you indicated that you would. The main reason for this generalized statement is something called the interest subsidy. So this is a benefit that if, and this is what I was referring to on the last slide as well, that if your monthly payment isn't enough to pay all of the interest that's accumulated for the month, the government will pay 50% of any unpaid outstanding interest. So the government's going to pay 50% of any unpaid outstanding interest that's accumulated on a monthly basis. So if you're planning on deferring your loans, it might make sense to take advantage of this free money the government is offering. And the same thing for if you're planning for a 10-year repayment, or even paying more aggressively, might make sense to take advantage of the interest subsidy. It's a counterintuitive approach, but I've found that it can be more productive than or efficient than paying off those loans aggressively initially anyway. I'd be happy to go through a strategy one-on-one just to make sure that what you're thinking is a sound strategy as well. So it probably popped up a lot of new questions here. I'll just kind of round this out here before we open it up. And I know we're nearing the 5 o'clock time frame here too. So 30% of you did want to pursue the public service loan forgiveness, and that number may have been higher, but some of you may have concerns that the program might not be around in 10 years. You may have heard that people have applied now after 10 years of payments and not gotten their forgiveness. Well, in order to change the public service loan forgiveness plan, it takes an act of Congress. And what's happened in the past is when they've made these legislative changes, they've grandfathered people in. So I suspect if they do make a change, which they probably will at some point, but the language will probably read something like this, where if your loans are dated 2020 or newer, you've got this new set of rules. But if you're prior to that, like all of you as residents, you would be grandfathered in. Regarding those people that did not get their loans forgiven, my understanding is that they were not in compliance. Maybe they didn't have the right set of loans or weren't working for the right company, or done some, I guess, didn't have things set up correctly. So it doesn't take a lot to get things set up, but you do have to work for a nonprofit, a 501c3 specifically, which 90% of all nonprofits are. You have to work at least 30 hours a week and make 120 on-time payments. You also have to have direct federal loans and sign up for one of the plans listed here on the screen, the repayment plans listed on the screen. So after making 10 years of payments, your outstanding loan balance would be forgiven 100% and income tax free. So you have to work for a nonprofit, have direct loans, and be signed up for a qualifying repayment plan. Now, if you don't plan on working for a nonprofit, you can also have your loans forgiven after 20 or 25 years of making payments. Now, unlike the public service loan forgiveness, whatever is forgiven after that period of time is taxable. So now with any repayment strategy, it's important to run numbers. And there's a lot of calculators out there to find a strategy that might fit for you. But I've looked at a lot of those calculators out there, and I have never really found one that's versatile enough to answer the questions that I have. So I actually made a calculator myself that would take into account changes of income, getting married, having kids, filing taxes separately or jointly, and different changes like that. So I can show you an example using that calculator here in a little bit. But before we do get to those details, I am going to show some numbers. And if they are close to your numbers, please know that for the sake of this presentation, I made some generalizations. So your details will not be exactly like those that are going to be listed. So we should sit down and run your numbers specifically. And so please do not base your decision to enroll or not enroll in an income-driven repayment based on what you're going to see. And I can't stress that enough. There are too many variables to consider to base your decision on that. So careful consideration and calculation is essential in determining the right repayment plan. So what we have here is a calculator with resident that has $250,000 in loans. The interest rate is at 5%. So signing up for the 10-year standard repayment, the payment would be $2,652 a month. We've entered in income here, $50,000 starting out for 3 years, increasing at 5%, and then landing a job with $200,000 income, increasing at 2% annually. Retirement contributions are set, as well as just one person in the family. We're going to look at the revised pay-as-you-earn repayment type, and we'll be looking at the adjusted gross income. Like I had said, it's based on adjusted gross income, so that's subtracting your retirement contribution out from your proposed income. So in terms of what your payment might look like over the course of the 10 years, initially your payment would be $242. Now, if you actually apply for revised pay-as-you-earn or any of these income-driven repayment plans appropriately, your payment might actually be $0 a month. So I can help coach through how to get that taken care of, at least in that first year. But you can see over the course of 10 years, the payment here is no more than $1,600 a month, which is far less than the 10-year standard payment. So after making 10 years of payments, you would pay in a total of $135,000, and they would forgive income tax-free $222,000. So that's a big number, and that's almost as much as the original loan balance. Now, if you were to pay over the 10-year standard repayment plan, your payment, you would pay in about $318,000. So you can kind of see the difference on how that works. So which repayment strategy is best for you? So every situation is different. So please do your research. And as you know, there's a lot of information out there and a lot of different opinions. Unfortunately, none of them know your specific situation, so don't rely on those opinions to make your financial decision. So I do recommend meeting with an expert, someone that knows about federal student loans. And this is a niche that I've actually excelled in. Unfortunately, there are not a lot of financial advisors in the nation who know much about these types of programs. I am aware, though, that there are different people or companies that do charge for student loan advice on how to structure your loans and pay them off. So if you want to pay a fee, there are services out there as well. You could also consult your loan servicer regarding like maybe what loans to consolidate or which repayment type is best. But I do caution that you shouldn't always rely on what you hear from them. I've heard a lot of times that they're giving wrong information or information that doesn't benefit you. So you'll want to double check that information. It's always good to have a contingency plan, a plan B. With any financial decision, it's not possible to account for all the variables that can come into play over the next 10 or 20 years. So having a solid plan B is important. So in terms of next steps, if you're interested in more information, there's some resources on the screen. I'd be happy to set up that free consultation to talk about any of the student loan concepts or topics that we've talked about here, or anything else. Like Dr. Walsh mentioned, you can bring a family member, a friend along. And even those 18% are feeling very confident about their student loans. I met over 70 people about student loans last year, and only one person had everything set up correctly before coming in. So there might be a little tweak or something that might save some money over the long run. I do typically hold meetings downtown Minneapolis and do schedule meetings in the Green building, Green 2, down from Anna's office. So when it does make sense to meet face-to-face, we can do that. Eventually we can shake hands and bump fists or whatever the acceptable greeting will be at that time. But for now, we'll have to be productive on a phone and internet meeting. So I thank you for your time and attention today. I know we're over time here. What questions can we address? I'm willing to stay here as long as the questions are coming in. So.
I am not seeing any at the moment, but I'll give it a minute to see if somebody submits one.
And that's a lot of information we went through, and
yeah,
perhaps I said everything perfectly, and that's not possible.
Can you talk more about having a $0 payment early in residency?
Yeah, so on the application for an income-driven repayment, there's a question about, has your income substantially changed or gone down? Most people are going to say no to that question, and they'll pull your income tax return in from the prior year. So they'll be pulling in your 2019 tax return. So based on your tax return, they'll derive your payment amount. If you have not filed a tax return, You still have until July 15th to file, even if if you didn't earn income. I do recommend filing a zero return. And that's something that we can talk through if you want as well. But if you file that zero return, they'll pull in that 2019 tax return. So.
And then another question was, does HCMC qualify for the public loan forgiveness?
Yes, HCMC does, as well as the University of Minnesota. And I believe all but 2 hospitals in the state of Minnesota also qualify as eligible employers.
And then I just wanted to let everybody know that they should look out for either tonight or early tomorrow. I will be distributing an email that has complete information about health benefits and other benefits, the packet that has been displayed during presentations today, and then also a presentation on benefits and also how to sign up for your 457, which is a quick turnaround. So there will be instructions on how to submit that. Usually it's my understanding that that has been a physical form that's been turned in, but due to COVID, it will be electronic this year, I believe. So just keep an eye out for email communication about that. And then, is there a way to get the $0 payment early on in residency if I file taxes jointly with my wife?
No, there is not a way to get a $0 payment if you file your taxes jointly with your wife. Now, if you file your taxes separately with your wife, you could then sign up for the pay-as-you-earn repayment type, and then they'll just pull your income in to derive your payment. So then your payment would be $0. So that a lot of information there, but that is another option.
It's looking like that's it for questions. Oh, what is the general difference between repay versus pay?
The big one is the interest subsidy that we talked about. That is not available on the pay as you earn. The other difference is anyone is eligible, as long as you have direct loans, anyone is eligible for the revised pay as you earn. You have to have loans dated after October 2007 to be eligible for the pay as you earn. The formula for deriving payment is identical. The other thing I just pointed out is if, depending on how you file your taxes, the pay as you earn can pull in just your income versus the revised pay as you earn automatically counts both spouses' incomes no matter how you file your taxes. So those are really the main differences.
Any more questions?
Maybe someone's typing a really long question.
I know you have to reapply for repay or pay each year. Can you switch from year to year?
Yep. So, and I believe they've passed legislation that you will no longer need to reapply every year. And that might be an opt-in or an opt-out. I haven't seen anything about that yet. I'm not sure when that's going to take effect. But yes, you can sign up for revised pay as you earn this year. And actually a month from now, or I guess not now, but let's say you sign up and your payments start in January. In February, you could switch to a different repayment plan. So you don't have to even wait the entire year to switch repayment plans. Now, there's something called capitalization of interest that is a big factor when it comes to loans. I didn't touch on that today, but that is a term that you should be familiar with. Interest capitalization. I can speak more to that now, but want to be sensitive to time as well.
Every time I say no more questions, there's a question. I
I
think,
don't think there are many more.
yeah, I think we're safe.
I think just everyone either take a photo of this slide so that you have the resources available to you, or screenshot or something. And David, thank you so much for taking the time again this year and working with all of these residents, which has been super helpful. We have lots of options for touchdown space on G2, so we could set you up if there are people that it's just easier to talk to you face to face or mask to mask versus via Skype. A lot of times people with papers and things. So thank you very much. And any other questions, feel free to email Anna or I, and we'll get them over to David. Otherwise, you can message him directly. Thanks, everybody. Anna, next step plans for day 2.
Oh, yes. So we are going to load your content that should be completed by the 22nd. And so that will be loaded to the LMS tomorrow morning. And that is kind of at your own pace. Just try to make sure that you get it done before the 22nd. And so you can look for that. And then for the next couple of days, it's kind of that and what has been communicated directly via each individual's program in terms of your appointments to meet with them.
And we will circle back with those who couldn't get access to some of the apps so that we can figure out from the backside kind of why they're not working.
And we are also going to have everybody loaded to Teams tomorrow morning.
So that way too. All right, everybody. Thank you for your first day. Welcome. This is just sort of not the fun welcome we usually give you, but we're super psyched to have you. And so many residents have stopped me in the hall asking when you start. So there are a lot of folks looking forward to seeing your smiling faces. So thanks, everyone. Have a good evening.